Hey everybody, this is Chen with Trader to Be, and today I'd like to talk about using trade setups with the average daily range. So the objective of trade setups using the average daily range is to help us assess the risk reward ratios on an intraday basis that is realistic. This technique will essentially allow us to know how much a stock typically moves on a day, and this technique is also built upon understanding the ATR. The ATR is the average true range, which essentially calculates the volatility of a stock on a particular day. The difference here with the average daily range is that we're going to take the ATR and multiply that by several days. So in this case, we're going to use 5 days. And from that, we're going to average out the 5 days volatility to give us an average daily volatility. Based on this information, we will know how much a stock is expected to move, and this will allow us to set up highly probable profit targets. Now, this method is useful for those who have trouble understanding where to put their profit targets, for those who tend to be scalping the markets quite a bit, or for those who want to set up realistic risk reward ratios to capitalize on a position once they've entered a trade. So the average day range or the average daily range is similar to the ATR as I mentioned earlier. However, instead of looking for 1 day's volatility, we're looking for volatility over several days and using the average of that. In order to do so, all we have to do is take the highs and lows of the trading day. We take a look at the range over several days, and then we average out that median price to give us an idea of how much any particular stock will move on a several day period. So here is an example of MU, Micron Technologies, and in this particular stock, we are looking for the highs and lows on the trading day. So we'll use this as an example here. We take this level here, the lows of the days and the highs of the days right here, and we calculate the price range within this bar for 1 day. And if we do this over a several day period, we will get an understanding of how much a stock like this will move over a week, 7 days, 10 days, 20-day period. So moving on from here, we can see that the highs and lows of the day for this particular stock, the price traded at the highs of 60.41 and the lows of 57.02 for a daily price change of $3.39. Now, if we take this and do the same thing over the last 5 days, we can see down here that we have an average 5 day price fluctuation of $13.71. We divide that by the 5 days and we get $2.74. What this means is that over a 5 day period, the intraday price fluctuation for Micron Technologies fluctuates about $2.74. Now that we know the average day range is $2.74 on this particular ticker, when we set up a trade for this particular stock, we can assess the probabilities of achieving our reward. So if we know that the average range will be $2.74, we can begin to ask ourselves questions like, what are the chances of me gaining 100% of the ADR or catching the entire $2.74 move on this particular ticker on the day? What are the chances of gaining 75% of that move on a day, or 50%, or 25% of the average day range? The higher our percentage of the reward, the harder it will be. What this means is that if we are trying to achieve 100% of the ADR, in this particular case is $2.74, the harder that's going to be. If we're trying to achieve 50% of that, it's going to be much less difficult. Anything below 50 is less difficult to achieve. Anything above 50% is more difficult to achieve. But as we can see here, anything around 50%, we're still looking at over a $1 change in price for MU. And understanding that will allow us to know when we enter this particular stock, we can let this stock ride for at least over a dollar. We're looking at maybe $1.30, a little bit more around there. So that would be about 50% of the average day range on this particular stock. So once we understand this, we can set up healthy risk reward ratios that will allow us to capitalize in the markets. Let's say in this case, we know that the average day range over the last 5 days is $2.74. And we want to extract 25% of that move, which is roughly around 68 cents. Now we have some realistic reward ratios that we want to achieve. But what about our risk ratios? If we want to set up a typical 3-to-1 risk reward ratio, then we would want to set our risk at about 1/3 of that 68-cent reward, which is roughly around 23 cents. So when we enter a trade on MU, we are risking somewhere around 23 cents to make a 68-cent reward. And because that's only a 25% average day range on this particular stock, we know that there's a very high chance that we can achieve this target. And so when we take a look here, we can see that in this particular range, when we enter a position, we don't want to be entering in this particular area. We don't want to be entering in this particular area. We want to see the markets ride up to about here and then pull back and retest this level. Once it retests this level here and fails, this is when we'd be looking to enter a trade. The reason being is because our risk to the downside, if it breaks the lows of the days here, would only equate to about less than 23 cents to our risk ratio. However, our reward is 68 cents. We can expect to achieve something all the way up to here. And because we know the price has traded in this area before, we know that this is an optimal risk reward ratio to achieve on this particular stock when we're trading it. So in conclusion, the average daily range can help us set up realistic reward ratios when we're intraday trading the markets. The more days we have averaged out on any particular stock using the highs and lows, the more accurate the average will be. The higher we set up our percentage that we want to extract from the move. So if we're trying to go for 50 or 75%, the harder that probability will be. So it's better to use a much more volatile stock, but then keep our ADR percentage under 50. That way we'll have a higher chance of achieving our targets. One last thing, this technique is really useful for those who are new to trading, for those who are unsure where to set their risk reward ratios, unsure where to set their profit targets, who are prone to scalping the markets and don't have the confidence to hold on to a trade for a very long period of time. This particular technique, using the average daily range and understanding how to set up optimal risk reward ratios by attaining about 50% of that average daily range, will help you set up better trades. I hope you guys find this useful. Give this a thumbs up if you like this, and I'll talk to you guys next time. Bye.